Hi everyone, my name's Darryl Payne, CEO of As Good as Gold Australia, and today I'm joined by my brother Brian and partner at As Good as Gold. And this afternoon we have the privilege of chatting with former economic advisor to Senator Arthur Sinodinos. John has frequently spoken about Australia's vulnerable economic environment, and in particular brought this to our attention again in February 2018 when he published a column in news.com.au titled "The 10 Signs We're Heading for Economic Armageddon." John says that when the economic earthquake hits, don't be surprised to see soaring interest rates, massive falls in asset prices like shares, real estate and bonds, and higher unemployment and widespread bankruptcies. John is predicting a collapse likely to be more severe than the 1991 recession, the 2008 GFC, and possibly rival the 1890 and 1929 depressions. The message is that Australians need to take some precautions in preparation for some difficult economic times that may very well lie ahead. At this point, I'd like to introduce our guest for today. Welcome, John Adams.
Thanks for having me.
Pleasure, John. Look, John, this would be alarming news to a lot of Australians. Can I first ask you what has led Australia into this dire position that we're in right now? And then what we'd like to do is refer to the 10 signs that you've talked about that taking us down the path of economic Armageddon. So firstly, why are we where we are right now?
Sure. So basically what we have seen over the last 27 years since the last Australian recession, which was in 1991, is we have seen a tremendous amount of growth in fiat currency money in the Australian economy, and that money has gone into debt and into the housing sector, which has created the biggest bubble in Australian history. At the same time, we've got the biggest bubble in the history of the world. So 100 years ago, the definition of inflation was the growth of the money supply, whereas the economists have rigged the definition, and the government is now saying that the official definition of inflation is growth in prices, and they measure it by the growth of the CPI, and the CPI doesn't include all prices. So here's a graph that I have that basically shows the difference between the money supply, which was so this is broad money which is published by the RBA, and which is the yellow line, and the grey line is the CPI, which is the official measure. And obviously you see a very big difference between what has happened with the money supply and what has happened with prices. And that difference, if you think about inflation is the growth of money, that is what I call Australia's hidden inflation, and that it has caused massive structural imbalances in the Australian economy, which in my view are completely unsustainable.
I mean, a lot of Australians would be totally unaware of what we're talking about right now.
Yeah.
I mean, I guess the 10 points that you've highlighted would indicate that. I mean, sign one, you make reference to these 10 signs.
Sure.
Sign one, you refer to record Australian household debt. Could you just expand on that a little bit and maybe just compare it to the position we may have been in 2007, 2008? Or
Sure. So household debt today is at 2.34 trillion. So it's a record high. Household debt as a proportion of disposable income is at about 188%. So that is a record high. I mean, obviously this is the biggest measure of that metric in Australian history. So think about the 1880s, the 1920s, the two periods before, the two depressions we've had in Australian history, which was 1890, 1929, and the level of debt is basically higher than where we are or where we were in those two periods. And obviously here's a relationship that I've been showing members of Parliament, which is something I uncovered in the data, which is to say, so credit to housing as a portion of the economy. So this is it's credit to housing is a statistical series that the Reserve Bank puts out, and at the last recession it was above 20%, about 22% of the economy credit that was going to the housing market. Today it is at 96%, whereas when you look at the amount of credit going into the business sector or credit going into non-mortgage debt, it's basically been flat for 27 years. So when we've seen this massive growth in the money supply, where has that credit gone? That credit has gone into the housing sector, and the data underlies that. And so why have we been able to achieve this? It's because we've had record low interest rates, not only in Australia but around the world, and it's created this massive incentive, plus with all the other incentives like with the tax system, etc., for people to go borrow enormous amounts of money and pile it into housing. And so if rates went back to their long-term average, the average mum and dad wouldn't be able to make their repayments, and that's why it's unsustainable. And this is what I call these structural imbalances in the Australian economy.
Wow. Yeah, I mean, it's. These long-term low interest rates that we've experienced that have created this household debt in real terms, the incentive to spend. I mean, this is a record, isn't it? I mean, so far as the longest stretch, one could say, of low interest rates. Is it historically a record?
Yes. So I think in Australian history, the level of interest rates, which is the official cash rate of 1.5%, it is a record low in Australian history, and the length of time in which interest rates have been low in Australia and around the world. I mean, so we are at pretty much unprecedented levels. And obviously since the GFC, global central banks lowered interest rates to zero, did quantitative easing. This is unprecedented in human history. It's created $80 trillion worth of global debt, more than where we were in 2008. And this is why I say this is the biggest Australian debt bubble in the history of Australia. At the same time, we've got the biggest bubble in the history of the world.
Wow. Brian, you've got a reference there. I know that you had a question too, or a sign too.
Absolutely.
You want to refer to.
Good afternoon, John.
Good afternoon.
When I go and see a lot of clients, it is imperative to me that I find that savings are non-existent, because a lot of our clients like to buy gold, but they can't afford to, right? So we talk about silver and that they can afford to do that. But the question is, and sign number 2 that you're talking about, is falling Australians' household savings. Can you talk to me more about that?
Sure. So what we saw in the data after the GFC, well, actually before the GFC, during the Howard government, people were borrowing so much money that savings in the Australian economy was actually negative. So on a whole, no one was saving, and we were actually borrowing more than what we were actually saving. So it went actually negative. Then when the GFC happened with Lehman Brothers, everyone got spooked. The household savings ratio went up to about 10%. And what we've seen in the last 10 years is that the savings rate continues to fall. So people are getting more into debt, consumption is up. And economic growth in this country is driven by consumption growth. And where are they getting the money from? It's from the reduction of savings. And 2 weeks ago, the Australian Bureau of Statistics put out the national accounts. Household savings ratio was at 2.1%, which is the lowest ratio since December of 2007. So, at the time when we're seeing global interest rates starting to come up in terms of the US, household debt is continuing to rise in Australia, and household savings are at a post-GFC low.
So that would be the reason why probably credit cards are on the up and up, and the amount of money being borrowed.
Well, to be honest, if you look at the data by the Reserve Bank, credit card debt is actually quite flat. So it's flat at about 52 billion. But where the growth in debt is basically in mortgages, particularly owner-occupied mortgages. And so people are using credit cards more. But what I think is actually happening is a lot of people are using refinancing, consolidating their credit card debt into their to include under their mortgages with their equity. And so this is one of the reasons why credit card debt is flat, is because people are hiding it by chucking it on the mortgage.
So where they used to be savings, now that savings is going into their mortgages too.
That's correct, and that's why owner-occupied mortgages, as of March of 2018, continues to grow at 8% per annum, and investment property loans are growing at 2.6% per annum. So still very healthy growth in debt at a time when we're getting massive volatility in the global economy and in the financial markets.
John, the next sign is I see we got major international asset bubbles keep growing. Obviously, the way I see it, if they continue to print money that money has to go somewhere.
Precisely,
So, yeah,
exactly.
Tell us more about this particular.
Sure,
sign.
sure. So one of the things that I wrote in the February column was that if you looked at the PE Shilley index, the US stock market valuations were higher than where they were in 1929. So according to that one index, the highest share valuations was in the tech boom bubble in 1999-2000, and then it was 1929. But by January, we actually, which is the market peak so far for the US share market, we actually had gotten above 1929 levels. So you look at that, you look at about half of the US housing market is actually above their valuations relative to 2006. So even with subprime and all that sort of junk, toxic assets in the system, some of the asset prices for housing in the US have actually peaked, particularly on the East Coast and the West Coast. But then when you look at Greenspan has said that we're in a global bond bubble, and he actually used the word bubble. CNBC said it several times. So yeah, like you said, when you print money, the money's got to go somewhere, and it's largely gone into financial assets like bonds and shares, or it's gone into physical assets like either we're seeing in some commodities like lumber, I think in the US has gone to a record high, but also into housing and global housing, has gone up, in most cases to record highs, whether it's China, US, Australia, Canada, etc.
Yeah, well, I mean, it's obvious here with inflation. I mean, we're seeing it in properties.
Yeah.
I'm not sure if this is accurate. Maybe you can inform me here. But we believe that housing in Australia is escalating at around 8-10% per year. Over 10 years is 100%. Obviously, that's unsustainable.
Yeah.
But that's where it's all heading at the moment, isn't it? So,
Yes.
What do you see as a likely outcome from that? I mean, how long can this be sustained?
Well, I mean, in terms of how long, I mean, that's obviously a very difficult thing to predict. One of the things that I have been telling members of Parliament is that the Australian history is that we tend to be complacent. She'll be right. We incur massive amounts of debt. Something blows up overseas, what I call international shock, and then we get swept through because that stuff passes through the financial system, and then Australians get hit indirectly, but in a big way. So what I tell politicians is, in the course of human history, you've never seen big bubbles end up without a major economic disruption, and the question is not if but when and what's the trigger. They're hard to predict.
Okay. Brian, you've got
another comment on that.
Question.
It seems to me, just referring back to the asset bubbles, if we have a rise in interest rates, which is good for the economy to keep the suppress, or to have a suppression of the amount of money being loaned, but then we don't have the growth. So it seems to me we're in a bit of a pickle.
Exactly, and so that was a sign that I sort of outlined in the February column as well, is that we're starting to see central banks around the world to raise rates. So the Americans have been quite aggressive in raising rates. I think last year you had the Canadians raise for the first time in about 5 years, the Brits also, and we're seeing some other central banks starting to rise. Obviously the Australian, the Reserve Bank of Australia has not raised yet, but what has typically happened in world history is when you get a big bubble, interest rates start to rise, and then at some point someone in the system will say, I can't pay, they default, and then that cascades to what I call in the column a critical event, which is where you get a big institution, a bank, a major corporation saying I'm insolvent, and that typically melts down the market. And so when we look at the 6 scenarios later in the interview, that's my scenario 1 of a debt deflationary depression or recession. So now that we've got the biggest bubble in Australian history, biggest bubble in the world, you're seeing rising interest rates, you're going to start seeing if those rates continue to go up, it's going to reach a critical point in which some people are going to start to say, I'm going to default. And a number of smart cookies are shorting the US junk bond market, and they're thinking that could be one of the initial sources of where the defaults will come from. But it cannot be mathematically that you've got all of this debt, and when the interest rates go up, that people can just continue to pay the interest repayments. So at some point something's going to give way, and I think we're to that critical point sooner rather than later.
Okay, you've got point in sign 9 here. You're making reference here to the yield curve.
Yeah.
I believe the bond market is
Yeah.
always a very strong indicator of a market crash.
Yeah.
And I believe at the moment, and so an inverted yield curve is a very strong sign. I think a crash always follows when you have an inverted yield curve. Is that correct?
It is.
And you make reference to it here now.
Yes.
So could you just expand on that a little bit?
Sure. So there was a paper put out by the US Federal Reserve last year that basically said that the most accurate predictor of a recession is when the yield curve inverts. So in a healthy bond market, you expect to get a higher rate of return the longer you've invested your money. And obviously when the yield curve inverts, which is basically when the 1 year US bond yield goes higher than the 10-year, the market is indicating that they have a lack of confidence.
Yeah.
And that lack of confidence requires bondholders to get a higher rate of interest for a short amount of time compared to investing their money for a longer amount of time. And that lack of confidence then typically indicates that that bad economic times are happening. And so this 1 to 10 year spread with the inversion, so it hasn't inverted yet, but it's obviously getting a lot flatter. We have seen some inversions in the Chinese financial system last year, but in the US research it says that once this the 1 year goes higher than the 10 year, then a recession will follow between 6 to 24 months after the inversion. And that's obviously what happened with the GFC, happened with the tech boom bubble, happened with the 1989-90 recession, about 12 to 18 months before these events. The yield curve inverted and we saw it. Now obviously in the 87, the yield curve didn't invert and the stock market did crash, but there was no recession. So we could still see a share market crash with even if the yield curve doesn't invert, but we're at about 57 basis points, which is the narrowest spread since the GFC. And I think if they continue to raise rates in the US, that spread's going to get closer to the point of inversion. And if that happens, it's think about a bomb with a detonator and a timer. Once it inverts, the bad guy has hit the timer, and unfortunately in this movie, there's no good guy to stop the bomb before the timer's about to run out.
And how close do you, you're not Nostradamus, but you are an economist. How close do you think we might be to seeing an inversion of the yield curve?
So sure. So 57 basis points is where the spread is now. I think Governor, the chairman Powell, basically said that expect another rate rise in September as well as December. So that's what the Federal Reserve is indicating to the market. And obviously, we're seeing higher readings of inflation in the official measures, even though in my view those measures are rigged in the US. So even with those official measures, you're starting to see higher inflation, so they want to get on top of that. So I think potentially by September or December, we potentially could see the inversion. But with all of these things, hard to predict. Sure. But it's just looking about economic history, looking at the fundamentals, and just thinking to yourself, how can is this going to turn out different to world history? And there's no logical explanation as to how do we get out of this without major pain.
No. You also mentioned sign 10, risky derivatives. Now everybody thinks back to as soon as you say that, they think back to 2007, 2008 and the GFC.
Yeah.
And that these risky derivatives, shall we say, synthetic collateral debt obligations, were very much responsible for the GFC. I hear that there are investments in these areas again, so we're seeing a repeat of what we saw leading up to 2007, 2008.
Yeah.
Is that correct?
Yeah. So there was a story on Zero Hedge which sort of triggered me to put in the column. I think there was a report by Citigroup that basically indicated that a synthetic collateralized debt obligation by a different name are back in the market. These toxic assets are being sold. Obviously the rating agencies pre-GFC rated them AAA, even though they were nowhere near AAA, and so there was massive. I mean, even in the Australian courts, they were found to be misleading investors about the true nature of the quality of the assets. So we're starting to see a lot of this these instruments being put out again. And obviously there's been no reform of Wall Street, there's been no reform of the credit rating agencies. I mean, they say that these are our opinions, these are not to be, actually Moody's actually says, you know, our reports are not to be considered as current or historical fact. I mean, that's the disclaimer. We're not presenting facts, we're presenting an opinion. And so why should the market trust an opinion when they were historically wrong, and that we're seeing these instruments being sold? So I think the estimate was that they'd be selling about 100 billion of this stuff in 2006. And even when you're looking at with the deregulation program that Trump has put in place, Congress with the Republicans has actually wound back some of the Dodd-Frank regulatory requirements that were put in after the GFC with Obama. The Congress has just repealed a number of those things back. So when you think things were already toxic, well, a lot of the restrictions that were holding some of these banks back, they repealed those requirements in the last 2 or 3 months in the U.S. Congress. So you know the Congress is going completely in the wrong direction with this sort of stuff, and we are seeing more risky assets and derivatives back in play, just like we did in pre-GFC.
Wow. You've mentioned that there are a number of scenarios that could take place based on these 10 points that we've mentioned, 10 signs that we've mentioned today.
Sure. Yeah.
And you've referred to that in six pathways to Australia's economic Armageddon.
Yeah.
6 scenarios that could take place.
Sure.
And I think all Australians should know what they are.
Sure.
So if you could explain those to us, and then if we could do that.
Sure.
Love your response.
Sure, yeah. So what I'll do is I'll just hold up look at the diagram here. So basically, so this is an article I published last Monday on news.com, and basically to say when you've got the biggest bubble in the world like we do now is one of two. We've really got 1 or 2 pathways in terms of the money supply and interest rates. Either we raise interest rates, or we keep interest rates suppressed and we try to keep the bubble going. Now, if we take the first path, ultimately it's going to lead to a default. But that default depends on who holds the debt. So if it's the private sector, if it's financial corporations, we typically will see what I call a deflationary debt, a debt deflationary depression or recession. So that's basically scenario 1, which we've described earlier in the interview. If it is the government defaulting, that's what we call a sovereign debt crisis. And some people are calling for or predicting that we'll have a sovereign debt crisis in Europe that could engulf the global bond market, which could potentially spread to the financial markets across the world, shoot interest rates up. And then obviously because Australia has $1 trillion in debt, those costs from the international credit market would be passed on through the banks to ordinary mums and dads. And if their rates went up quite substantially, and 80% of the market is variable interest, a lot of ordinary mum and dad Australians could be caught out by seeing rates go up quite quickly, independent of the Reserve Bank. So that's your scenario 2. If a country defaults on its external debt or its foreign debt, and obviously you look at what happened with Argentina, their currency has fallen 25% this year. The Turks have seen their currency fall 15% this year, and this is concerns about their ability to meet their external debt obligations, their foreign debt. So if you see that happen, that's basically you get a lack of confidence in their ability to pay down their external debt, and you see their currencies collapse, and that's what a local currency crisis is. And there are 2 economists, Peter Brain and Ian Manning, they wrote a book last year called Credit Code Red, and their forecast for Australia is that we will default. We are at a great risk of defaulting on our external debt. So our net foreign debt in Australia is 1 trillion, gross foreign debt is 2 trillion, and we don't have much of foreign exchange reserves to cover our currency if we have a major currency depreciation, and their forecast is that in potentially in the next 2 to 3 years' time, as the world situation gets more dicey, we potentially could go into a local currency crisis. So that's basically scenario 3, and I should say part of putting these scenarios on the table is to say, well, I didn't want to box myself in and say it's going to be X, because we know that this is going to be an extreme event, one form or another, but it could manifest itself in a range of different ways depending on a range of other circumstances, and those circumstances ultimately will result in or will be derived from human decisions made in the future, which I don't know what they are. So I didn't want to basically say it's going to be specific, and I just wanted to give the reader a broad spectrum of what potentially could happen. So we've covered the first three scenarios, and then obviously if the world central banks keep interest rates suppressed, and obviously with low interest rates, quantitative easing to keep the bubble going. I mean, obviously you guys are in the gold and silver game. You guys know that ultimately when you print so much money, the money itself, the fiat currency, becomes worthless, and that leads to runaway inflation. So in these scenarios of 4 to 6 is basically a derivative of that basic premise. So scenarios 4 is runaway inflation, hyperinflation at a localized level. We've seen that numerous times, whether it's Venezuela today, or Zimbabwe, or Weimar Republic Germany.
Yeah, exactly.
Scenario 5 is looking at stagflation, is where you have accelerating inflation when you've got low economic growth. Greenspan has said this is what he thinks is coming to the United States. A couple of other people have said that stagflation could be happening around the world. And as in the article, I outlined a range of factors which may limit economic growth from occurring, both in the global economy as well as the Australian economy. And Kyle Bass, who's a hedge fund manager, recently said in an interview that M2, so global money supply versus against global GDP, is at 110%, whereas the average in the 20th century was between 30 to 50%. So independent of printing more liquidity in the system, he says there's a lot of liquidity that could lead to stagflation going forward. And obviously the scenario 6 is if governments and major corporations lose confidence in the money, like particularly in the US dollar, we could see a global currency crisis, which results in international governments not being willing to transact because of the mechanism in which the transaction is being made. And that's obviously the Jim Ricketts forecast, which is to say that if the Chinese don't want to accept US dollars and they say pay us with something that we think is valuable, and you get a breakdown of the global international monetary system, that's your global currency crisis. So they're the basic 6 scenarios that I've mapped out. A couple of days ago, I was in Melbourne speaking with a couple of economists, Peter Brain and Ian Manning, and one of the things that was quite vivid in the conversation with them was, the whole proposition about getting out of jail without any sort of major damage. Their point to me was that it's taken 27 years to build up the debt bubble in the Australian economy. So for any politician who thinks that we can just get out of this without any major pain, they think that that's pretty much a fantasy. It's taken a very long time for these things to build up. In theory, it would take a very long time for these things to unwind, but given where the world economy is going to go, a lot of people think that it's going to come to a head at some form or another in the next probably 2 to 3 years, and that's not enough time for the Australian economy to really unwind the amount of debt in the system. Because what the policymakers are doing today is trying to slow, if you think about a stock and a flow, they're trying to slow down, in theory, the amount of new credit in the system, although owner-occupier mortgages are still growing at 8% year on year, which is quite high. Let's see what happens in the current quarter. But no one's talking about the stock, the existing debt, which is huge. And so the policy measures is really just looking about slowing down the rate of growth, hoping that people will have money to pay down the debt. But we're looking at the savings data, and people are saving less. So the debt bomb is the stock, and that is just sitting there, ready to explode if interest rates go up.
Of the 6 scenarios, John, what would you expect to be the most likely to prevail?
So I think the most likely scenario is, so you look at the bond market now, you look at the US raising rates. So it's clear that the yield curve is flattening. It is, and the spread between the 1 and 10 year is narrowing, so we can see that in the data. So it's very likely that will invert at some point later this year, which could mean that we could have some sort of recession crash next year. Whether that's in the developed world or the developing world, I mean, it's still hard to see because the developing world obviously borrowed about $20 trillion, largely in US dollars, and the number of these countries will struggle to pay the money back as US interest rates go up. But I think when that situation does happen, the response by world central banks and government is to basically try to repeat what they did in 2008, which is probably to print more money and to have more stimulus and to do all of that sort of stuff. If they let the system go, we would have a depression. If they try to intervene, which I think they'll intervene because the politicians probably don't have the gumption to do the right thing, and in my view the right thing to do is to get the debt out of the system, which is to let the market, what Rudd would say, to let the market rip. Well, the right thing to do is actually to let the market rip. Yes, there is short-term pain, but if you kick the can down the road, which the world did in 2008, the problem just magnifies where we're here today. So I think we're going to have some sort of market event, some sort of crash. Central banks will intervene. They will print. They printed 15 trillion after last GFC. I think they'll try to print a lot more relative to last time. So we potentially could see, governments trying to bail out banks. We could see them trying to use what the 2012 Cyprus models were, which was in terms of the bail-in, in terms of taking people's money. Obviously, we're seeing the war on cash, trying to digitalise people's savings so that if it's not physical, they can't actually get the money out of the system. So we could see some quite a few things that they attempt to keep the system stable, but I think that if they try to do that, there'll be massive political ramifications in terms of political instability, but also I think we would see potential loss of confidence in money if they try to, because they'll have to print more than 15 trillion. So how much more would they have to try to print the next time? We're not sure. Some people say 50 trillion, some people say 100 trillion, but in theory, if they try to print into oblivion, well, the money, the fiat currency is worth less, and then gold and silver relative to that fiat currency should skyrocket.
Yeah, well, we all know what happened 2007, 8 through to 2011. We know what happened with precious metals. When gold went to something like 1900 US an ounce, which was a high.
Yes.
Silver, $50 an ounce. We get a repeat of that. I mean, people will always go to the safe haven investment.
Exactly.
And gold and silver have got that historically over 5,000 years. It's a safe haven. So I guess the last question I'd like to ask you, and it is a difficult one to answer, but do you believe that precious metals, gold and silver, could surpass the levels they reached in 2011 at $1,950 an ounce?
Sure. So I think if you look at look at just from an economic perspective, if there's a lot of liquidity in the system, so I think gold and silver should be a lot higher than where they are today. If they obviously try to flood the system with more currency, more credit, then obviously you should expect to see more a higher price for gold and silver under those conditions. So I think the short answer is yes, but obviously someone like a Jim Rickards or a Jim Rogers would say that a lot of this is driven by confidence, sure. and I think I mean, obviously, some of the reaction to some of my columns has been a lot of people still have an inherent trust in the system and trust in money, although there's still a lot of ignorance about, well, what is money and how does this all play a part. But I think if they start to see in real time their economic conditions falling apart, that's when confidence will collapse. I think a lot of people will say, well, what do I do now? There'll obviously be a lot of people advocating for gold and silver. A lot of people will be looking for getting their money out of the banking system, whether it is cash or whether it's gold and silver. So I think we should be seeing gold and silver go up after the next crisis. But on the assumption that they print more money into the system. But obviously at the end of the day, a lot will have to do on confidence, and I think confidence is intact, relatively speaking, today. But I think that confidence can go quite quickly when things start to unravel.
Sure. John, I'd really like to say thank you so much for Brian and myself. Thank you so much for your input today. It has been outstanding. And because we know you're really busy, and for the viewers, John's driving back to Canberra, I think, is it?
Tomorrow, that's
tomorrow.
correct, yes.
So it's a fleeting trip, a fleeting visit, but it's been terrific to have you at As Good As Gold Australia headquarters. And we will look forward to interviewing you if you'd like to. We'd love to do that on an upcoming occasion very soon, I hope, so that we can get more feedback from you, because your input has been sensational. Look, for the viewers, those who are viewing today, links to John's articles will be in the video description below. John has written a number of articles, as we've highlighted. He is a very, very shrewd economist, and if you'd like to know more about John's work, please visit the links below. From Brian and myself, thank you so much for joining in. Really appreciate your time, particularly yours, John.
Thank you.
And say thank you again, and goodbye for now.